Good morning, everyone. Thank you so much for carving out time during your lunch hour to join us. We will be starting here shortly in the next 2 minutes. We want to give other attendees a chance to trickle in. My name is Marina. I am the Energy Efficiency and Partnerships Officer here with Clean Energy Fund of Texas. If you have yet to meet me, hopefully you guys can see my screen. I'll do a quick intro and then we'll get started. Feel free to put any comments or questions in the chat as well. And we'll get started here in about 1 minute. Please let me know if you can't see my screen. You can type it in the chat. All right, let's get started. People will join hopefully as we get a little bit deeper in this. Welcome. My name is Marina. I am the Energy Efficiency and Partnerships Officer here with Clean Energy Fund of Texas. Thank you again for carving time out of your busy schedule, especially during lunchtime, the most important hour of the day, to join us. I want to also give you an idea of who we are if you are new to what we do and who we are. We are a Clean Energy Fund of Texas. We are the first nonprofit green bank for the state of Texas. What does that mean? We're a nonprofit financing company that works directly through contractors to deploy money to all Texans, regardless of income, regardless of socioeconomic background, regardless of credit. We want every Texan to be able to access the energy efficient upgrades they need for their homes. So that can be anywhere from a roof to solar to HVAC to everything in between. And you are also privy to our actual launch of our connected webinar series. So not only do we want to help you close deals as contractors, we want to see you thrive. And so what does that mean? Connecting you to resources to help you grow and maintain your business, whether there's other opportunities for lines of revenue, but also opportunities of work to help you meet those gaps for your business. In this case, we're going to talk a little bit about small business lending through our partner CDFI BCL of Texas. And before I hand the mic over, I also wanted to share and plug, if you're a contractor that currently services the Houston area, please join us next month, April 16th, for our Centerpoint Energy Lunch and Learn. We're going to talk about how you can stack our financing with their incentives to make your jobs much more attractive to homeowners and be able to solidify those deals. If you want more information, please visit our website. And that's all I have. I'll do a quick intro. I want to introduce you guys to Shane Wilhelm. He is the Business Development Manager with BCL of Texas. BCL of Texas stands for Business and Community Lenders of Texas. They are a CDFI small business lending financial institution, and they work specifically with people like you, small business owners that really want to grow and see their business thrive. And with that, I'll hand the mic over to Shane. Shane?
Hi, good afternoon, everyone, and thank you so much for joining us. I am excited to present to you on a topic that is near and dear to my heart. I come from a family of contractors, and myself, I also own my side hustle is running a custom furniture and cabinet making shop in my garage. And so I've got a family full of electricians and painters and machine operators and a contractor and a mechanic. So this is near and dear to my heart, and so I hope that you're able to get some valuable information out of today. If you have questions along the way, feel free to pop those down in the chat or in the Q&A. And if it's something urgent, we'll try to address it right then. If not, we'll save it towards the end for Q&A and save plenty of time for that. So today I'm talking about how to get to yes. So what I mean by that is how to prepare your business for funding conversations to help you grow and scale your business. Most entrepreneurs don't get denied for business loans or lines of credit because their business is bad. They get denied because they're either early or they're mismatched to the wrong type of loan that they're applying for. So today we're going to talk about how lenders and bankers think and what you can do to control and prepare for before you ever even apply. I'm going to show you how to translate your job site success into the patterns that lenders need to see so that you can get to that magical yes. A little bit about BCL of Texas. We are a statewide here in Texas 501c3 nonprofit organization. We wear a couple of different titles as hats. We are a certified development corporation, so we do 504 loans with the SBA. Those are generally for major equipment or warehouse manufacturing facilities, or if you needed to purchase commercial real estate. That is a loan product that we wear or that we provide there with our CDC hat on. We're also a CDFI, a community development financial institution, which is another way of saying, a really long way of saying that we are a nonprofit lender. So we don't work like traditional banks. It gives us a lot more flexibility to customize loan products for what our borrowers actually need. We've been doing this over 35 years. Through our work, we've helped support and create over 8,000 jobs through our business lending. That's had an over $7 billion impact here in the state of Texas. And we've deployed $64 million. And at this point, it's well over $70 million in just the last 5 years. So we've got a lot of experience here in Texas. We have offices in Dallas, in Austin, and San Marcos, but really we operate statewide. And I grew up in the Houston area. And so really we cover a lot of territory. So let's dive into the content here. Why does funding feel so hard? You may say, I make money. Why was I denied? Or I was told no, but no one explained to me why. And then every lender says something different to me. These are comments that I get on a weekly basis of people reaching out for funding, and they get hit with a dead end and a brick wall. And so let's dive in a little bit deeper. I don't know if this sounds familiar to you, if you've ever been in that position, but I'm going to do my best to try to help you understand why you may have ended up in that spot. Because it's not really about denying, about your denials. It's not anything bad about your business. Maybe you're not quite ready for that type of lending, or maybe the product that you're applying for isn't the best fit for what you're looking to do. So let's talk about how lenders actually think. I have a few different roles in my job. I'm the business development officer, which i.e. I'm a loan officer for our organization. My first goal is to protect the capital that we do have so that we can lend it out to really great businesses. My second job is to manage risk. I've got to make sure that we get repaid. First and foremost, if we don't get repaid, we don't have funds to lend out to the next business. Here's some things that are not in our wheelhouse, is investing in unproven models. I'll say it again, but lenders are not investors. And it's not our job all the time to believe in the opportunity of your business. It's our job to look for patterns, to look for consistency, and to look for the history that you've been able to deliver as a contractor. And that's what we base everything on. So because of that, it's hard for us to take your word for it. We've got to trust but verify. And another thing that's not my job is to risk losing money for the organization that could support other businesses. We don't finance ideas, we finance patterns. And so I want to kind of pull the curtain back a little bit and talk about what you need to be aware of with your credit, your financials, your business's financials, so that you understand the patterns that we're going to look for whenever you come to us. And it all comes down to the 5 C's of credit. And hopefully this is not new for you, but if it is, congratulations. This is the first step in getting to yes. The first C that we're going to talk about is character. And what does that mean? We're going to look at your personal credit history. We're going to look at the reputation of your business. We're going to look at your credibility. Can you deliver on what you say you actually do? And then we're going to look at your experience. How long have you been doing this? It's about trust for us as an organization. Can we trust you, and are you trustworthy? The second C is capacity. Capacity is cash flow, not revenue, but cash flow at the end of that profit and loss statement, at the end of the month in that bank account. Do you have enough cash left to service a loan? We're going to look at something called your debt service coverage ratio, meaning there is a magic number that every lender uses, and some of them use different numbers than others, to say you have to, if you're asking for, and I'll just throw a number out there, if you're asking for a $50,000 loan, do you have enough money coming in to support that $1,000 a month loan payment? Or if it's on a 3-year term, around a $1,600 a month loan payment, do you have enough money coming in to cover that, plus a little bit extra in case something else comes up that might be unforeseen? Are you operating with high enough profit margins? A lot of times, and I've been guilty of this myself, is underbidding on a project so that I get the business, and then I regret it after the fact because suddenly I haven't made any money. I got the business, but at what cost? I haven't made enough money to cover the expenses of taking on that job. The next C is capital. It is looking at you as the owner. How much have you invested into the company? Are you over or under leveraged? And what I mean by that is, do you have more debt than you can currently pay? And because of that, you're over leveraged and you don't have enough to support any new debt or any new lending or line of credit. And by owner investment, we want to see that you've got skin in the game, beyond just your work and the time that you've been in the business. We want to see that you've personally invested your own funds into the business. The next C is collateral. And this is where we're going to look at the assets of the business and anything that we can use to help secure the loan. With BCL, our policy is anything over $50,000, I usually have to have collateral on. That can be things like property that you may own aside from your home. We cannot and don't want to use your home, but in the state of Texas, it is illegal to use your home for business collateral. And a lot of folks are not aware of that. But what other assets do you have? Do you have heavy equipment? Do you have vehicles that the company owns? Do you own a lot that's maybe a storage lot where you park your trailers or equipment? So what do you have there? And then what is the value of that relative to the value of the loan? If you're asking for $50,000, but the only collateral you have is a 1993 Toyota Tercel that's worth $250, that's not going to get you very far. And so the other thing we're going to look at is what other security options might you own. That may be a retirement account that is not your primary 401k. It may be an alternative investment account. It may be you have a cash value life insurance policy that could be used as collateral. There's other things that can be used as security or collateral for a loan. And then the fifth C is conditions. And this is about timing and industry risk more than it is anything else. It's how you're using the funds. It is, how is the economy doing? Is your industry struggling in this economy because there's a downturn in new construction? If you're a new home builder and there's a downturn in new construction, it's going to be harder to get financing just because the industry might be down. And that might not have anything to do with you. or your business performance, but it's the climate of where the industry is at. And those external forces often have a way of affecting how we're lending as a lender. I'll use COVID as an example. During COVID, the big places that were shut down were restaurants, hotels, and other hospitality businesses. And so not the best time for a hotel or a restaurant to be applying for a loan is when all of them are struggling to keep the lights on and the bills paid to begin with. So think about those sorts of things. Are there any external factors that might be coming into play? So really, I want you to think about what your weakest one of those C's might be and things that you might be able to do to improve it. Next up, let's chat a little bit about why good businesses get a no. A no usually means the lender can't get comfortable with the risk yet. This might mean that you have inconsistent months where you get paid for the job and you're doing really great for 2 or 3 months, and then there's a lull between jobs and you've got no income coming in or greatly reduced income coming in. It could be a matter of weak documentation where you're not really tracking and staying on top of all your financial reporting as a business owner. It could be applying for too much debt way too soon. And so I want to try to help understand why you might be getting a no so that we can turn that around and use that towards getting to yes. So let's look at inconsistent cash flow. As a lender, I first off have to look at your business financials and show and tell your story that every single month your business can take on and manage taking an additional loan payment when it's in its current financials. And oftentimes I get questions about, well, if I have this money, then I can make the loan payment. But we don't want to loan you money just for you to have the same exact money to loan back. We want a loan or a line of credit to be a tool that helps you grow and scale the business, that creates other opportunity for growth. And so having money just sitting in an account to pay it right back is not going to do you any good, because you're going to pay more interest on that money that is in your account than what you would be getting in interest from your banker or financial institution. So we first and foremost have to prove that your business can support that new debt. Weak or missing financials. This is something that I have struggled with myself. I know this industry, and like, I'm a great woodworker. I'm a great cabinet builder. Because of this job, I've gotten much, much better at managing my financials, but it's something I never really paid a lot of attention to. Money was going in, money was coming out for supplies and materials. As long as more money was coming in than going out, I wasn't worried about it. But tracking your financials, tracking your expenses, tracking your cost of goods, tracking the cost of equipment leases and payroll taxes and all of these other things are going to help us understand, do you have that capacity, going back to the 5C of credit, do you have the capacity to take on this additional debt and support it? And can you utilize it to grow your business? Another thing that we see pretty commonly is owners of a business taking too much personal draw. They're siphoning every dollar out of that business to the point that it's not showing that the business has the capacity to take on any additional debt. We see this frequently, and I get it, because you're like, well, this is my day job. This is my only job. This is where I have to pull income to support my family. And so I really want you to think, are there any margins there where you could leave a little bit of money in the company account so that during slow months or during lulls in the business, you have those retained earnings to show that you still have the capacity to cover those loan payments. So be careful how much you're taking out personally. If you don't have to take it, there's no harm in leaving some money in the business. That's going to help save those funds for a rainy day. And then the other thing that we see often is a mismatch between the loan and the business stage. Oftentimes I get requests for $200, $300, $400, yesterday $600,000 for a business that hasn't made that much money in a year, that has no experience managing that amount of money. And so sometimes it's a matter of, are you biting off more than you can chew, so to say? Are you asking for too much money too soon in the business versus saying, let me start with 20,000, let me start with 30,000 or 50,000 and prove what I can do to utilize those funds to grow and scale my business and really enhance what I'm doing, and then show what I can pay that back. And when I can show that history and that growth, then that gives me another opportunity to come back at a future date and apply for more funding when I'm ready for that next stage of growth. So no often means not yet. It's not that you're a bad business or that you're doing things wrong. Um, but if you pay your personal bills directly out of your business account and you're pulling too much personal draw or any of these other things, then we can't tell if the business is actually profitable when we're looking at those financial statements. So let's do a little bit of a reality check here. Can you, as a business owner, explain your numbers clearly? Do you know how much your monthly operating expenses are costing? Um, do you know before you ever have a conversation with a lender how much debt, how much of a monthly payment you can handle? I always use a car lot as an example. I've been in so many car dealerships and I've seen people say, well, it doesn't matter how much the car costs. I can only afford $400 a month. Well, if I'm the salesman, I'm going to sell you the most expensive car I possibly can, and I'm going to stretch that term out as long as possible, but I'm going to get you down to that $400 a month because I want that bigger sale. That's not always the best solution. Vehicles these days, some of them with 84-month loans, might be lucky if those vehicles are still running in 84 months. So really understand how much debt you can handle over a period of time. Uh, the next thing I want you to think about is this the right type of capital? Oftentimes, businesses come to us, and really what you might need is an investor who can be patient and they can wait 6, 8, 12 months, 24 months before they start getting repaid. Other times, you might need a line of credit where when business is doing great, you're not utilizing it. But if you have a slow month, then you draw down on that line of credit, or maybe you hire an additional employee, or you need additional pieces of equipment or something along those lines. You draw down on that line of credit. You utilize it to help ramp up operations or take advantage of getting that new tool and putting it in operation, or hiring and onboarding a new staff member and getting them through that training phase to the point that you can start generating additional revenue and paying that off. And then in 6 months, 5 months, 3 months, whatever that window looks like, you need to do it again for the next staff member or the next piece of equipment or the next upgrade, or just to kind of float you during a slow season or between contracts. Then you can utilize that line of credit. And in the meantime, you're not paying interest on money that you're not utilizing right away. Like I said earlier, you're never going to generate more interest in a savings account than what it's costing you to borrow that money. So just be mindful of those things. Is it the right type of capital? And then, have you reviewed your own personal credit? Um, Before you ever have a conversation with a lender, you should know every great thing on your credit, that you've got a solid credit history, you've made all your payments on time, or you should know any challenges that a lender might bring up to your attention and ask you about. I ask these conversations before I ever open a loan application for any borrower. I have conversation with them one-on-one. I said, what am I going to see when I look at your credit? Am I going to see a history that shows me that you handle your responsibilities, that you make your payments on time, that you meet your commitments? Or am I going to see frequent missed payments and charge-offs, or multiple bankruptcies, or any number of other things? And listen, we understand as a nonprofit borrower that everyone has a past. We want to see that you've learned from that and that you've taken steps to correct it. I don't mind when I see someone that they say, you know what, 4 years ago, it was a tough time for my industry. I lost my job. I couldn't make my credit card payment. There's some missed payments on there. But what I did is, once I got on better footing and stable ground and I had my finances stable, I went back and I took care of those things. I would rather see something bad that you made good or something good that never had to go bad than see something bad that you ignored. So understand what's on your credit and be prepared to speak on those things whenever you talk to a lender. The next thing I want you to think about is, have you worked repayment of the debt into any of your financial projections? I use the number $50,000 a lot because the math is easy for me. On a 5-year term, that's roughly $1,000 a month with today's interest rates. And so have you already planned, if I take out a $50,000 loan, can I afford that $1,000 a month payment? And if the answer is yes, show me in your numbers where you've already worked that into your plan. If revenue continues as it is today, I can make that $1,000 payment, and here's what I'm going to do in the future to still be able to make that $1,000 a month payment. I love it when people come prepared for the conversations like that. So let's talk about choosing the right type of lending, the right type of financing for your business, because there's several different types of organizations that do this. The most common that everybody knows about is banks. They're established, they're profitable, they do these loans all day long. They have what's called a credit box, and that literally means you have to fit the box of what they're looking for, the industry they're looking for, the size of your business, the size of the loan request, your personal credit, and all of these different factors have to fit kind of neatly in their box that they've already prepared. And that works for a lot of people. And so banks will do that. And you'll hear the term traditional lenders a lot if you're ever in this space. And that's what they're referring to, is traditional banks. Many of you might have heard about SBA loans. They can be a little bit more flexible. They can deal with a few blemishes on your credit oftentimes, but it is a much slower process. And in this day and age where we run into government shutdowns that might affect the SBA staff, that's going to slow down processing times. And there's also various restrictions on how funds can be utilized. At the beginning, I mentioned that we're a 504 lender. A 504 loan is an SBA loan that is tied specifically to commercial real estate and equipment. You can't use it for payroll. You can't use it for inventory or supplies or working capital. It's not an eligible use of funds for that type of loan. Then there are 7A loans, which is a different type of SBA loan that is designed for that sort of thing. It's designed to handle working capital and fill inventory gaps and that sort of thing. So understanding that they can be flexible, they can be really great tools. And we are an SBA lender. So we do both of those types of loans, but they can slow the process down a little bit. If you're looking for a quick turnaround, they might not be your best option. A third type of organization is what we are, is a CDFI, a Community Development Financial Institution. Similar to traditional banks, we oftentimes have established loan products that we target certain industries. But we also, rather than ask you to fit into our box, I like to say we build the box to fit you as the borrower. We want to make sure that you're meeting a public purpose. Every loan that we do, I have to check that box. Does this meet a public purpose? Is it creating jobs? Is it supporting a minority or a women-owned business or another demographic that we're really trying to target? Is the business operating in a low-income area of the city or a low-income census tract? And the other thing that we try to do is look through some of the inconsistent months by connecting you with our business coaches. Nearly every loan that we do, we ask you to meet one-on-one with our business coach on a monthly or quarterly basis just to do a check-in. We want to make sure that you have access to all the tools that possible to help you be successful. There's often times where people will come to me and they want to apply for a loan and they might not be ready yet. They may not have their financial statements ready. Their credit may need some work. They may not have a business plan to effectively communicate what their business is and how it finds its customers and the services it provides. Those are all things that I need as part of a loan application. So oftentimes what I will do is I will refer that person over to one of our business coaches and they'll work with them and help them get ready for the lending process, and then they'll send them right back to me. And I recognize a coworker of mine, Leo Pozobon, on the call here today, is one of our small business and entrepreneur coaches. And we actually just closed a loan for a contractor in Dallas who needed to purchase a dump trailer. He also needed some additional working capital so that he could be prepared to take on bigger jobs. And this is a borrower that wasn't ready. He didn't have his documents in order. He had some things he needed to address. He worked with Leo for 3 months, and Leo sent him back to me ready, prepared, and we just got his trailer purchased last week, and he picked it up this week. And so he's able to move forward. So sometimes that's the benefit of working with the CDFI. If you're not quite ready to have those conversations with a traditional bank, or you don't check all the right boxes, or understand if an SBA loan is even the right product for you, then maybe a CDFI is a great solution for you, or another lender in that space. There's also alternative lenders. These can be very fast. If you listen to any kind of radio, you may have heard the advertisements. Funding in as little as 24 hours. If your business makes this much a month, we can get you funding in 24 hours or less, up to 200,000 or 2 million or $5 million. Those can get really scary really quickly. There's also, if you use QuickBooks or take online payments or credit card payments of any type, there are all these other merchant capital accounts, merchant cash advances. There's a couple of different names for them that say, hey, based on your sales for the last month, we'll give you $50,000 in 24 hours. We'll fund it directly to your account. And don't worry, there's no interest. We're just going to charge you a one-time flat fee of $6,000, which is probably more than what the interest would have cost on that loan anyways. And then they say, and we'll just take the money out of your account every Tuesday, or we'll take a portion of every transaction out of your account until it's paid off. And we estimate that you'll have this loan paid off in 7 months. The problem is paying back $50,000 plus $4,000 to $6,000, $8,000 in fees over such a short period of time most often will destroy your cash flow and prevent you from being able to do anything else. Most businesses don't have that high of a profit margin where you could lose $12,000 a month and still be profitable. And I say lose $12,000 a month being taken to pay that loan off at such an aggressive rate. These can trap your business in high interest debt, even if they don't call it interest and they call it fees. It can be a very expensive debt to take on, and it kills your profit margins. And just so that everyone is aware, last year, the SBA said if your business has any of these MCA accounts and these MCA debts, we will not refinance that into a SBA loan. And because of that, a number of banks and other lenders have followed suit, and they said if we see a pattern of your business utilizing these predatory loan options to try to get a quick fix, we will not refinance you out of it, because it's almost like the equivalent of a payday loan or one of these car title loan places that you see for consumer lending. Oftentimes what we see on our side is if a business utilizes it, it diminishes their cash flow on the very first one to the point that they take out a second one to help cover the cash flow, which further destroys their cash flow in the long run. And then I've had businesses that have 4 to 7 of these all at once, and they're spending more money on monthly debt service than they're actually making top line before they cover any of their other expenses. So they get very, very difficult to deal with. So think about it this way. The wrong type of capital can slow your business down. It can make it such a deep hole, or that you are having a difficult time to crawl out of it, like with those alternative lenders, or it can take you a long time if you have an option to purchase a piece of equipment on sale and you need to move quickly. It can be very difficult sometimes to get other loan products to help you get there that quickly. So how do we get to yes? Step 1 is clean up your financial basics. Make sure that you have your profit and loss statements ready. And I always look for 2 years. A lot of the times you have to have these to file your business taxes anyways. So it's a good idea to just hold on to them. And if you work with a third-party accountant, make sure you're meeting with them on a regular basis and you understand exactly every line item on that statement so that you can speak to it whenever you're talking with a lender. It's always a red flag for me whenever I'm talking with a borrower, a business owner, and they're like, I don't know what that means. Let me go talk to my accountant. And they reach out to their accountant twice a year, 3 times a year at most on a normal basis. And so if there's no communication there, I don't know if that accountant is filing things properly. I don't know if the business owner has a handle on where his money is at. And there's a chance that if he doesn't know where things are at and where he stands financially and understands his own business's financials, that taking on a new debt may not be the best thing for him at the moment because he may not understand how he's going to pay it back in the first place. So make sure that you have your profit and loss statement, and a balance sheet is always super helpful. Help me understand what assets your business has, what long-term debts there might be. Do you own any property? Do you have any work trucks or trailers or other equipment that's financed long-term? That's all going to show up on a balance sheet. So help me understand those things from the very beginning so I can add that into my calculations. Number two is match your business to the right type of funding. To me, smaller, manageable debt is better for scalable, manageable growth. Someone who says, oh, well, there's a market out there that if I had $500,000, I could go and address this entire market and I could grow to $10 million in 9 months. I don't want you to do that because there's a very, very high likelihood that if you're not used to dealing in the millions, that you're not going to be prepared for that level of growth and it will overtake you. I would rather you grow organically, understand it from the ground up, and have a handle on your entire business operation the entire time. So I would rather work with you one loan at a time, one scale step at a time as you grow your business. The next thing, prepare for the lending conversation. I've said it, I have one-on-one conversations, and our business coaches and our other team members have one-on-one conversations with every business owner that comes to us looking for lending. And we have those conversations so that we understand before we ever open up a loan application, how likely it is that we're going to be able to get them approved the first time. And if not, how can we get them with coaching and their other types of support first to get them ready for lending. We don't like sending an application to somebody just to have to tell them no. That's not what we want to do. Every application we send, we want to be able to get to yes. And so prepare for that conversation. Understand where your credit is at. Work on those 5 C's. For a contractor wanting a new truck or equipment, we want to see how that specific piece of equipment will help you take on more jobs, increase your revenue, and provide some conservative projections, some safe projections, so that we know how that new debt and that new tool or that new person that you're hiring on your team is going to affect the business. I know that on the desk side of the business, that you probably don't spend a lot of time there, and you spend more time on the job site than behind a computer. But these documents are kind of the homework required to get the funding you need to grow your business. So if you decide to hire an accountant, again, make sure that they know your industry, that they know your trade, and they know how your business operates. Teach them what is common for you and what might be abnormal for you. You can have that conversation like, hey, I'm going to do something a little bit different than normal. I just want to make you aware of it before I start sending you these invoices or these receipts for this project. And make sure they communicate with you on a frequent basis so that you have that grasp on your business's financials. You don't have to fix everything all at once. You can take it one step at a time. And honestly, working with a business coach is a great idea, especially if you've never been focused that much on the financial side of the business and you've only been focused on the product, the service, the delivery of what you're offering. So I always like to challenge people to look at like the next 90 days. If you're a business owner, what can you do one step at a time over the next 90 days? And the first thing is, if you're an entrepreneur, a sole proprietor, a single operator with no staff, or even if you're not, even if you've got 50 guys underneath you, but you're running everything out of your personal checking account, please don't. That makes it impossible. I really don't care if you go to McDonald's 7 times a week. That's between you and your dietitian and your doctor. Um, but what I do care about is if I can't tell what's a business expense versus what is a personal expense, that's going to throw up some flags for me. So make sure that you have your business and your personal bank accounts separate. They can be at the same bank. You can make transfers to each of them if you need to pay yourself out of the business account. That's fine, but make sure that your business expenses are in one spot and your personal expenses are in a different one. So if you don't have that, please find a good bank. Go and interview 3 or 4 banks. Make sure you know what their fees are. Make sure you know what the benefits that they're offering are. A lot of banks will offer different benefits to different sizes of businesses that may be holding different amounts of money with them. So understand that. I'm a big fan of not paying yourself in cash. Don't go to the ATM and pull your owner's draw or your paycheck out of an ATM with the business card. Write an old school check and pay yourself. It's much easier to track. You get that little printout every month on your bank statement. And if I'm looking through a loan application and all the documents, if I can see where you're paying yourself and your employees, and that may be through a payroll company, that's fine. But if you're a small business and you're having to do that, I would rather you write a check and pay yourself. And I see in another bank statement that where you've deposited that check, I like seeing that paper trail. It takes all the guesswork out of it for me, and it speeds up the application process. So another thing, take a look at your credit before a lender does. Know exactly what's there. There's a ton of services out there that you can use to access your credit scores. But the best one by far is annualcreditreport.com. It is a government-owned website that allows you to access your credit report from all 3 bureaus. So understand what's there and be ready to speak to it. And if there's anything on there that you need to address prior to lending conversations, by all means, please go address it. That's going to make our conversation a much different conversation than if I say, why haven't you addressed this thing? And then the other thing is predictability. Work on a system to make sure that you have cash coming in or cash saved as retained earnings in your business account to cover debt during any slow months. And then some additional resources that I want to leave you with is the SBA. The SBA is a go-to resource for capital, for business coaching, for know-how, and for expertise. They have so much data that they can utilize to help you with projections, which kind of leads me to the next one, is the Small Business Development Center. These are a branch of the SBA, the Small Business Administration. These are coaches and business counselors that are stationed, most of them in colleges and universities around the state, but they are free for you to use and tap into. They offer tons of classes that you can sign up for virtually or in person. And they really, really work to make sure that you are ready as a business owner to apply for lending, that you've got a handle on your financials and that you understand them and can speak to them. Some of you may have heard of SCORE, which is funded by the SBA. These are business mentors that have been there and done that, so to say. There are different mentors in different industries, so I would recommend finding one that knows your industry, that has been in your industry. Most of these folks have retired or sold their businesses, and they're doing this as a way to give back. And so working with the SCORE mentor is a really fantastic way to get ready. And then the other one is CDFI lenders like BCL of Texas, where we have business coaches and entrepreneurs on our team to really help you understand all of these things and to help you get to yes.